Hello everyone. Great work on the initial submission of project number 2. This is a quick video to kind of walk you through some of the parts of the calculation and clarify some of the confusion. And to highlight the Excel worksheet template provided pretty much kind of covers all aspects of the calculation and really fits into the tax return 1065, page 1, and Schedule K, and the individual partner carries K1. And the calculation also will support your memo to read in Word. So therefore, I'm going to cover the calculation in Excel in more detail and highlight some of the issues I have seen from the initial submission to help you finalize the submission due on Sunday. First off, from a formation perspective, I have seen most of you are able to utilize worksheet to get most parts, uh, not all, if not all of them. First thing we want to see is really there's no gain or loss recognized on the formation of the partnership. That's a general rule of thumb. And the outside basis is composed of 4 different types of items: cash, services, property, as well as a debt assumed by the partner. So in this case, uh, we're looking at a relatively straightforward formation of the partnerships. There are 3 partners. Each partner took on 1/3 of a partnership interest, and Reed and Doug contributed cash, and for Carrie, she contributed 460,000 worth of land. Adjust basis goes to the outside basis in the partnership interest. The mortgage attached to the land is something that's a little bit unique. In this case, the reason being is because the 60,000 mortgage attached to the land, on one hand, will reduce the carrier's outside basis due to the debt relief, because through the contribution of the land, the mortgage attached to the land is basically essentially is took on by the partnership. Therefore, this will be considered as a debt relief from the carrier's perspective. So $60,000 will be used to reduce the outside basis of the carrier's partnership interest. On the other hand, because the partnership took on the $60,000, and therefore each partner will take on the $20,000, the debt allocation will increase the outside basis in the partnership interest. Therefore, this mortgage attached to the land has really 2 sides, two implications for Carrie as well as for all partners. So this is something it's a little bit unique, and also for this mortgage on the land, because this is secured by a real property, and the assumption is the mortgage is borrowed from a qualified person, a bank, and therefore it's considered as a qualified non-recourse financing. And the bank loan is recourse debt, and the 1.5 million is allocated equally to each of the partners. Once we identify all the components, the initial tax basis is a sum of all the items we captured here. Okay. And as far as the opening tax basis balance sheet, when we capture the cash will include the cash contributed as well as the cash obtained through the debt financing. And the land, the 460,000 will carry the basis carry over from Carrie, the original owner, to the partnership. And the liabilities include the mortgage, 60,000, as well as the 1.5 million borrowed from the bank. And the capital will be whatever left over from the assets minus the liabilities. and divide by 3 because each of the partner have 1/3 of the capital interest in the partnership. Okay, so once the formation is done, we're going to take a look at the operation. And the reason why we want to start with the formation is because the formation will help us identify the initial outside tax basis. Then once we figure out the operation, basically the 2024 year's operation, then we can adjust the outside basis and to reflect the current year income loss and to derive the ending outside basis and a capital account as of year end 2024 to get ready for the sale of partnership interest or partnership interest liquidation calculation. So all the 3 parts are kind of connected in a way. So therefore, anything is missed in the first tab could carry over to the subsequent tabs. Therefore, it's important to kind of connect the relevant cells uh, to to between the tabs so you can have the updates done automatically. Once you go back and review certain items and update those items, and the calculation will flow through. Okay, come back to the operation. The operation, the sale revenue cost goods sold are pretty straightforward. Regarding the operating expense, one thing to notice is there's a $1,500 fine and penalties on the reckless driving. So this $1,500 need to be removed from the operating expense here and put in the separately stated item section because those fines and penalties are still part of the Schedule K item, but it is non-deductible expenses, so we need to include those down here. And once we have the depreciation, interest expense, all that figured out here, then we can have a total of ordinary income loss, and the total ordinary income loss will also become the net earnings subject to self-employment. And separately stated items will include the qualified dividends, tax-exempt interest, and Section 179 fines and the penalties. And once we figure out the partnership Schedule K, then the Schedule K1 is a strict allocation based on the ownership percentage. So that's pretty straightforward, and there's not much to it. So the amount subject to QBI is also the owner income loss plus any Section 179 expense. In this case, really just the owner income loss piece. Okay, and then once we finish the operation tab, the partners outside basis will be adjusted based on the income loss reported here. To note it is the outside basis is a carryover from the formation tab, and the ordinary income, business income, will be from the calculation above, and total separate state items cover everything, pretty much everything. So all the qualified dividends, tax exempt interest, non-deductible expenses, all that stuff. So to that's where people will say, okay, why do I need to include the non-deductible expense and the tax exempt interest into the outside basis? The reason being is the partnership's basis in the partner's outside basis in the partnership interest really represents the economic value of investment in the partnership, and whether the expense or the income is taxable or not, that will affect the partner's individual income tax reporting. However, as far as the tracking of partners' basis in the partnership interest, since we're looking at economic value or investment, no matter whether that income or expense is taxable or deductible, is irrelevant. So that's why we have to capture those tax exempt interest or non-deductible expenses here when we calculate the outside basis in the partnership interest. Okay, once we have that figured out, the next piece is the capital account analysis. The parent's capital account does not include the debt. Does not include the debt because the debt is disclosed separately. And however, the current year income loss also covers both ordinary business income plus the totally separately stated items. Okay. So once this is finished, then we're going to move on to the sale of partnership interest calculation and the liquidation calculation. For the sale of partnership interest, I have the numbers kind of laid out here. This is basically the sale of partnership interest calculation starting point is we're going to take a look of the partnership assets at the time of the sale, because we had to take a look at all the assets within the partnership for the calculation of the sale of partnership interest. The reason being is because we have to capture any hot assets, even though for the purpose of a sale of partnership interest, there's no assets are transferred from the partnership to the partner, but for the purpose of the calculation of the gain or loss on the sale of partnership interest, we need to take a look of all the assets within the partnership to figure out, which portion of the gain is ordinary, which portion of the gain is capital. Okay, so now let's take a look at the calculation, and this is a template from the chapter homework. And this is something that's kind of help you identify the different components. Of course, a lot of you have come up with your own calculation, which is great. This is just one of the calculation I put together to help you identify the steps, because this template can help you say, okay, this is the issue we're dealing with. This is what we need. This are step 1, this are step 2, and step 3. So a lot of times we want to make sure our starting point of the calculation for taxation is correct. If we start with the step 1 wrong, then all the subsequent calculation could be wrong. So whenever we're dealing with sale or partnership interest, the first step is to calculate the total gain or loss recognized. So in this case, we're going to start with amounts realized from the sale of partnership interest, including the debt relief, because the debt relief is basically the partner's debt, $520,000. So basically, we're assuming nothing is paid. Still, it's $520,000. The selling price is stated in the case is $730,000. And reads outside basis, this number is from the operation tab, because we did the calculation in the operation tab to derive reads outside basis in the partnership interest. Then the total gain or loss, that's step 1. So that's kind of the first step of the calculation to determine the sale of partnership interest. The second part of the calculation is really capture the partner's share of a gain or loss from the hot assets. And I think there's a lot of discussion about what are the hot assets in this partnership chapter. So in this case, the reason why we have to capture the hot assets is because we need to potentially recharacterize a portion of the gain to the ordinary income. So that's the purpose of this calculation here. So therefore, for this calculation, we really want to, to capture any hot assets only. So in this case, I kind of label the 2 possible. One we have seen through our homework and exercise. One is the unrealized receivable inventory cash. Of course, there's no gain or loss. We can put that there, but this will not, capture or will not affect our calculation. Equipment is this is only the accumulated depreciation. Basically, the depreciation recapture section 1245 recapture portion will be treated as hot assets. So in this case, the only thing will be subject to the hot assets is the 1245 section 1245 depreciation recapture. So what I'm going to do is I'm going to link this back to the sale of partnership interest. The sale of partnership interest, the inside basis is 333,000. The fair market value is 600,000. The total gain loss is 267,000. So really the potential gain or loss, this is the gain or loss as if the partnership sold this assets at the fair market value. So this is the overall gain or loss. The other thing we have to also to do is we have to apply the selling partner's interest percentage. So in this case, the rate only have 1/3 of interest. So therefore, the 267,000 has to apply the 33%, which will be equal to the 89,000. So that's the ordinary income portion, the 89,000. So once we figure out the step 2, then the remaining will be the overall gain loss minus the ordinary income, ordinary income basis ordinary gain, and the remaining will be the capital gain. So really, this calculation here, the key is step 2. So the first, we need to identify the hot assets. The second is you want to apply the partnership interest percentage, the partner's interest in the partnership. In this case, we're looking at selling partner rates interest percentage, which is 33% only. And once step 2 is done, and step 3 is pretty much finished. So that's the sale or partnership interest calculation. As far as the liquidation goes, we're going to take a look at the liquidation calculation here very quick. The first thing I want to clarify here is, in this case, because in our partnership liquidation Excel template, we have several templates because we have different scenarios. One of the two distinctive scenario is when partners outside basis is less than or greater than partnerships inside basis. That's the first thing we need to determine, is the partners outside basis is less than or greater than partnerships inside basis. So again, this is the first thing we need to determine. Then that will determine which template you're going to use. So the first thing we're going to see is, okay, what are the rates outside basis before the distribution? This something is the same as the operation tab, which we already calculated. In this tab here, rates outside basis before the distribution is 1.045800. So that's the outside basis. So that's already done. And what's the inside basis of the distributed assets? This is something, it's a little bit confusing. I think a lot of times is kind of trip people up, is because the inside basis include, because in this case, when the partnership is liquidating, what happened is the partnership is going to distribute cash as well as a list of the assets to REIT in this liquidation. Basically, there's a transfer of property from the partnership to the partner, to REIT. So this is very different from the sale of partnership interest. The sale of partnership interest, there's no transfer of property from the partnership to partner, because essentially, the purchasing partner took on all the assets and liabilities from a REIT. So at the partnership level, nothing changes. But when there is a partnership liquidation, in this case, really what happened is the partnership has to distribute cash and all the assets, plus you had to consider the debt relief, because in this case, through the liquidation, REIT also got rid of his liability on the debt for the partnership. So therefore, the 520,000 also need to be included for the assets distributed. This is the inside basis for the distributed assets for the liquidation. Let me just make this a bit clear. partnership interest. So therefore, this $520,000 also need to be included here because you had to look at all the stuff distributed from the partnership to partner. So in that case, when you compare the two numbers, one is outside basis, the other one inside basis, you will see the scenario fall into the partner's outside basis is less than the partnership inside basis. Therefore, there's a gain deferral of $115,000 and $200. And the allocable basis, the 525,800, really is a total outside basis, excluding the debt relief. So that's why if you do the calculation, if you try to figure out the allocable basis portion, if you just simply look at the outside basis, excluding the debt relief, excluding the debt piece, you'll come back to the same answer. But at the end of the day, what we have to really to pay attention to in this calculation is figure out the debt piece. I think that's the confusing part of part of the calculation. This outside basis does including the debt, but for the inside basis calculation, we also need to consider the debt relief as well, because in the partnership in the partnership interest liquidation setting, the partnership not only distribute the assets to the partner, also there's a debt relief component we have to consider as well. Okay, once we start with the right template, then we know in this case there's allocable basis 525, 800, and then there's a required basis difference between the two, because what we're trying to do is we're trying to compare the outside basis and inside basis and reduce the inside basis to the outside basis. So in this case, the difference between the two is $115,200. Because of gain deferral, we're going to reduce the basis of the assets received for the partner accordingly. So once we have that $115,200, then first I'm going to allocate to the cash. Allocate to cash 485. There's not much to it because cash to cash. 485,000. That's the cash piece. Then the second piece is we need to allocate the remaining outside basis to other distributed property that has unrealized depreciation to the extent of that depreciation. So in this case, we do not have anything. Let's see whether there's any unrealized depreciation. There's no unrealized depreciation. For equipment, actually there is unrealized appreciation. So really this step, nothing applies. There's nothing we're not going to allocate specific to this group. We're going to move on to the third step. So, after this, I have 115,200. So in this case, 115,200, I'm going to allocate this to, based on this, I'm going to allocate this to the two assets. So that based on the adjusted basis, 45, 111, that's adjusted basis. So you can see here, what I'm doing here is 115,200 divided by the ratio of the adjusted basis of asset A divided by the total assets. So risk allocation is based on the adjusted basis ratio. So once we have that, then this the two property distributed, which is the investment in stock as well as equipment, will be reduced. The basis will be reduced to 11,769 and 29,631. So in essence, at the end of the day, the partner's tax basis in the property received during the distribution will be equal to the allocable basis of of the partners allocable basis, basically the partners outside basis, initial outside basis minus the debt relief. So that is a 3 steps calculation. And once all that's done, the cash is 485. There's not much you can write down because we cannot write down cash value. And other assets will be, their basis will be reduced accordingly to match the allocable basis. So in total, there's no gain or loss recognized at the time of the partner's liquidation uh, of his partnership interest, and the assets we receive in this liquidation distribution will be reduced accordingly, and leave that with 11,769 and 2903. Okay, so with that, then you can figure out, once we finish the calculation of sale of a partnership interest and the liquidation of partnership interest, you should be able to compare and contrast the two options. Really, for Reed, if he chose the sale of partnership interest, he's dealing with immediate recognition of the gain. Of course, there's a portion of a gain is ordinary, one a portion of a gain is a capital. And for liquidation, if we choose the option of liquidation, really there's no gain or loss recognition, and he will receive some asset and receive cash as well as assets uh, to hold on to it. And of course, in the future, if we sell those assets, they could be subject to capital gain or ordinary gain, depending on how the assets are used. Again, it's really a timing difference, right? One is immediate recognition. The other one is you do not recognize the gain or loss right away. However, you do not receive the cash in full, and you're just gonna receive some assets in this case. So really, depending on the partner's tax situation, he can either choose you know sell partnership interest option or liquidation of the partnership interest. So it really depends on where he's at. And but in the memo, you do want to kind of outline the implications and think about some of the pros and cons, depending on uh, the partner's tax situation. Okay, so the last thing I want to kind of highlight is the tax return in PDF. The purpose of the exercise is for you to kind of take a look at the form and read the instruction of the form 1065 and Schedule K1, and kind of see if you have something you're not sure about, you want to refer to the instructions. And something I should want to note, um, highlight here is on the Schedule K, not only we have this the ordinary income loss piece, there's some separately stated items here on the top. Uh, there's a deduction, special deduction down below. There's also other information section, which is kind of a continuation of separately stated items, which covers tax-exempt interest as well as non-deductible expenses, which is fines and penalties, where those things should be. Schedule K1, similarly speaking, we have ordinary income loss, and we also have self-employment earnings loss. In addition, there's tax-exempt income and non-deductible expenses, and the ordinary dividends actually include the portion reported in 6B, the qualified dividends, which is a little bit unique, but according to the instruction, the ordinary dividends also include the qualified dividends. And other information will include any information regarding QBI, all that stuff. Okay, I think that's all I have for project number 2. And a lot of you have uh, done a good job on the initial submission. It's just a few pointers to help you finalize the submission. Good luck and have a great day.